Traditional banking forces you to hand over control of your assets to a third party. To bypass this system, an unknown entity named Satoshi Nakamoto introduced Bitcoin in 2008. It operates as a completely digital, decentralized cryptocurrency. The goal is to eliminate banks, hard cap inflation, and give you total authority over your own money. Historically, we traded physical goods like grain or gold to represent value. Eventually, this evolved into carrying government-issued paper receipts that promised that physical value upon request. This diagram illustrates the inherent flaw in printing paper money to create wealth. If only 1 kilogram of potatoes exists, and the government hands every buyer 100,000 rupees, the potatoes don't multiply. The price of the potatoes simply rises above 100,000 rupees. Moving to digital money required central banks to track every transaction. This exposes your funds to massive institutional risks. Banks invest and lose your deposits, as seen with Lehman Brothers or PNC Bank, or governments abruptly revoke the legal tender status of your cash altogether. You are trusting a few powerful institutions with full transparency and control over your personal assets. This flowchart shows how Bitcoin bypasses traditional institutions entirely. You purchase a digital address and transact directly with other users on an automated network. Verifying these global transactions requires thousands of computers. To prevent a single third party from taking control, Bitcoin uses a distributed blockchain. Individuals plug in their own hardware to run the verification algorithm. When a transaction clears successfully, these operators, or miners, receive newly generated Bitcoins as a reward. To defend against inflation, the algorithm is hard-coded with an absolute maximum limit of 21 million Bitcoins. The system automatically adjusts mining difficulty based on participation. In 2009, you could generate 200 Bitcoins in 3 days. Today, 1 Bitcoin takes over 150 years. Combining decentralized verification with strict mathematical scarcity, the network operates entirely without trust in a central authority. But practical usage is severely limited. Bitcoin lacks universal acceptance, its lack of oversight invites illegal activity, and its value fluctuates violently every 30 seconds. Because of this constant price fluctuation, a standard retail exchange, like a shopkeeper trying to calculate the correct fiat refund for a returned item, is currently impossible to manage efficiently. In India, Bitcoin is legal to trade, but the government does not officially recognize it. That puts 100% of the financial risk squarely on the individual user. The Reserve Bank of India even banned banking services for crypto exchanges in April 2018. It took a 2-year Supreme Court battle for those exchanges to successfully win back their banking access. While the government drafts future regulations, Bitcoin currently exists as a highly volatile, completely decentralized alternative to your bank. You can opt out of the traditional system, but you do so entirely at your own financial risk.